Okay, Fitbit's results are out and shares are down about 11% in after hours. We've plugged the new details for the March quarter and the updated guidance that management gave into our earnings model, and we're going to go through those details now. So if you'd like our earnings model, it's available for free on our website, gutenbergresearch.com. You can click on the Models tab, then you can scroll down to Fitbit model, and click this icon to download. And you can see we put a little note here that says that this has been updated after the 1Q16 press release, but prior to the conference call. So the conference call hasn't started yet. After we finish the Tesla call, we'll come back, listen to the Fitbit call, and if there are any additional details that come out of the Q&A section with the analysts, we'll update this model again and repost it to our website later tonight. So just, when we went through the results quickly, it's kind of crazy. A lot of these things were already explained by management on last quarter's earnings call, but even still, this company looks like a completely different company from the results that we saw last year. So if you look at the average selling price, the units, the decline in units was much deeper than what we had originally anticipated in our model from yesterday. At the same time, the average selling price per unit jumped. So it's now, if you just divide the total revenue by the total number of units, it's now over $105 per unit. And if you look at what it was in the last year, or even before last year, it's never reached that level. So, it's some interesting things that are going on there. It's probably due in part to some of the other revenue contributors, but even still, it's kind of interesting. So we had to update our average selling price for the next couple of quarters. So that was one of the good items. And also the other good item that we saw was the gross margin guidance. So they guided to 48% on a non-GAAP basis for the June quarter. And they left their gross margin guidance constant for the full year 2016, which was also good to see because it's still a relatively strong gross margin. If you look at last year, the average was about 48.5%. So it's slightly ahead of last year, which is good to see after a quarter where it dropped down to 46.6%. The other good thing that we saw was they beat the estimate for EBITDA margin, which was important. But at the same time, their guidance for the second quarter, the margin guidance was relatively low with the higher revenue base. So that wasn't so great. And also on the call last quarter, they talked about the sales and marketing expense as a percentage of revenue being somewhat equal to what we saw in the fourth quarter, which is where it pretty much came in. But we were kind of hoping to see upward revision in the results on the operating margin side for the June quarter, given that we know the manufacturing costs associated with Blaze and Alta, they should have stabilized a little bit after that first quarter because that ramp should have been pretty well underway. And at the same time, it's interesting to see such a high average selling price, but the revenue guidance for the full year of 2016 didn't really increase by all that much. So if that was a sustainable average selling price, you would expect to see better guidance for the full year 2016. So that might be part of the reason that shares are under pressure right now. And the other thing is, if they had the excuse for Blaze and Alta in the first quarter, saying that the reorders wouldn't be recognized until the second quarter. But based on the guidance, we just increased our unit sales growth quarter over quarter from about 16.6% for the June quarter to 21%, just because there was a sharper than expected decline in unit sales for the first quarter. So really, we're at about even with our unit expectations for the June quarter. But with this higher the higher average selling price, we'd expect to see better revenue guidance for the second quarter. So not really sure what's going on. It can't be the reorders for Blaze and Alta because they should have showed up in the second quarter. So not sure why this revenue guidance didn't increase by more, given that strong average selling price in the March quarter. Other than those few metrics, we did go through all of management's guidance. If you scroll down, it's right here. Where is it? Outlook and guidance section. So they give the full year 2016. We started with the second quarter, so revenue between 565 and 585, which we have in our model, midpoint. Non-GAAP gross margin at 48%. So we hit that there. Adjusted EBITDA in the range of 37 to 47 million, and stock-based compensation expense between 21 and 23 million. So we scroll down to the non-GAAP section. See, we hit the midpoint of the stock-based compensation, and we hit the midpoint of the adjusted EBITDA guidance, 42 million. So that equates to non-GAAP diluted EPS of between 8 and 11 cents. So with the midpoint, we got to 9 cents, and that's based on the share count, the midpoint of the share count that they gave guidance for. And that's about it. And we put the 30% non-GAAP tax rate in the non-GAAP adjustment section. So we're in line there. And we did the same thing for the full year 2016. So you can see management guided revenue between 2.5 and 2.6 billion, which was, that should be billion with a B. And that was slightly higher than the revenue guidance before, which was 2.4 to 2.5 billion. And they guided the EPS between 112 and 124 versus 108 and 120. So overall, our model is now recalibrated to meet the new guidance that management gave. It's available on our website if you want to download it and put some of your own assumptions in for the average selling price and the growth rates in units, or the OPEX items as a percentage of revenue. You can see what the impact is on EPS. So next we should talk about the valuation and after hours. Usually, if you follow our videos, we like to keep our valuation metrics in our valuation section constant after the earnings release, and just adjust the earnings in the model just to isolate the impact that's related to the new earnings news. In this case, because the multiple had been priced closer to the 3-month high on a forward basis using the next 12-month consensus estimate, we think the market was actually pricing in better than expected increase in management's guidance for the full year 2016. And that could have been due to the recent announcement with Alibaba. So maybe the market was looking for some better expectations out of China, or just a better than expected ramp of the Blaze and Alta products. And also, probably the market was probably looking for a reduction in the OPEX, particularly the sales and marketing expenses as a percentage of total revenue. And since those items didn't come to pass, we think the market is probably pricing shares closer to the average of the next 12-month consensus EPS estimate of 11 times. So down from about 14 times to 11. And that's where you get to the $15 to $16 price range. So if you'd like to download this model, you can put in your own valuation assumptions here. You can put in your own estimates and see what the impact is on earnings. Definitely check back after the earnings call tonight. If there are any significant updates, we'll make them to this model and make it available on our website. And also check back after the analysts have updated their own models. We'll recalibrate this to the new consensus estimates and post it. Thanks for watching, and good luck with the rest of earnings season.